All right, Thanksgiving's behind us. For you business owners, the year-end tax race has just begun.
That clock started ticking right after the turkey, and December 31st is approaching fast, real fast.
You've got about 4 weeks. That's it, 4 weeks to make moves that affect your entire tax year.
Look, waiting until April is just way too late. What you do right now is what really counts. So first up, let's talk about a common trap that so many business owners fall into.
You made that awesome donation on Giving Tuesday, but did it actually help your taxes at all?
Here's the thing. If you take the standard deduction, that donation might not save you a single penny.
But what if you could flip that? Let's talk about a smart move. Sponsorship versus donation.
Instead of just donating, sponsor an event. Get your logo on a banner, and boom, it's advertising.
Okay, next up, let's talk about that dead stock. You know, the stuff just collecting dust.
To get this, you first got to understand something called cost of goods sold, or COGS for short. See, that dead stock, it's actually hurting you. It's an asset that increases your taxable profit. Crazy, right? So the key is to get it off your books before the year is out, and here's exactly how. And now for the big one, the question I get all the time: should you go buy new equipment?
A lot of folks think buying a new truck or a laptop is some kind of magic bullet for their tax bill.
But here's a great rule of thumb. You should never spend $1 just to save 30 cents.
Think about it. You spend $1,000, you might save $300 in taxes, but you're still out $700. Now, if you actually need it, you have to follow these critical IRS rules. No exceptions.
So what does this all boil down to? Let's get to the most important pivot you can make. The real game changer is a shift in your mindset. It's not about sales, it's about your net profit.
So ask yourself, are you focused on your top line or your bottom line? That's the real question.